Hi, Dr. David Phelps here. I'm proud to announce the release of my newest book, Inflation, The Silent Retirement Killer. I started my real estate investing portfolio back in 1980 during a time when inflation was running at 14.8% and the federal funds rate was at a high of 20%. This after a decade of hyperinflation in our country, along with a very anemic economy called stagflation. Now look where we are today. We have hyperinflation again, moving that direction. We have interest rates going up, possibly triggering a recession. Could be back to the 80s. I know how to navigate these times. I've done it. I built my whole portfolio during times of a lot of volatility. In my book, I packed it full of information about how fiat currency can undermine the hard work and the wealth that you've tried to create. You've got to do things differently to protect that wealth going forward and the wealth generation you hope to pass on to your heirs. You can download a digital copy of my book for free at inflationbook.com. That's inflationbook.com. Author Vanita Van Caspel once wrote, "Inflation takes from the ignorant and gives to the well-informed." You want to be well-informed in this case. This is what I call the great wealth transfer. Be sure you're on the receiving side, not the giving side. Download a free copy of my book at inflationbook.com. Hi, David here, the CEO and founder of the Freedom Founders Mastermind community. In this economy, where we are right now, you need to have both cash flow and an inflation hedge. Why both? Well, in the last decades, really the last 4 decades, we've had very low inflation and we've had decreasing interest rates up until 2 years ago. Past COVID, inflation is rearing its ugly head. I mean, in a big way, more than we've seen in the last 40 years. Which has a real dire consequence on the best laid plans of those who have been saving money and aggregating it in different types of retirement accounts, wherever they might be. If you don't have a strong inflation hedge with that nest egg, those investments, then the inflation, the devaluation of the dollar is going to eat into the purchasing power of that hard-earned and hard-saved money, wherever it is that you've done. In fact, at a 12% nominal inflation rate, every 6 years, the purchasing power of $100 today goes down by $50, by half. So if you have a $2 million nest egg retirement plan, 401k, whatever it might be, and if you don't have an inflation hedge to keep it growing to offset the devaluation of the dollar, the purchasing power loss, in 6 years, that $2 million nest egg is only going to have the value to you in purchasing power of $1 million. Take another 6 years and it's down to 500,000. If you plan on going through very many cycles of 6 years, in this case, using this example, then you're going to find that that nest egg that you thought was going to be adequate for you will not be. And you're going to find scarcity amongst those final years of your life, which is never a good thing to do. That's not the plan. That shouldn't have been the plan all along. So where do you find those assets? I don't believe that the stock market is going to be the place you want to be. We've had a big bull run in the last 10 years. And if you've been a part of that in your 401k, whatever you've invested in, you've been a part of that, kudos to you. That's great. But now there's a corner being turned. And if you're not willing and able to figure out what to do amongst the change in the environment, then you may be hard hit, hard pressed. It's scary to make changes, but you cannot stay the course. Whatever got you to where you are today is not going to take you to that finish line, years and years and decades ahead. Cash flow. Why do you want cash flow? Well, it's one thing, again, to build up and aggregate or accrue certain sums of money. Cash flow, again, wherever that might be. Aggregating, it's one thing, but turning that aggregation into cash flow is the part that most financial advisors never get. They can never help their clients. They say, well, build it up, and then you can take out maybe 4% per year of the principal, and then whatever minuscule return you'll get, because we're going to put you in a safe environment. We're going to put you into bonds or T-bills. Well, of course, today, the rates are going up a little bit, but still not even close to the inflation rate. Again, you're losing ground when you're not at least getting the return that inflation is causing. And today, that inflation rate, the real inflation rate, is not what the government tells you in the CPI. It's probably about twice that. Just bear in mind that the government always manipulates the numbers just to look good for the constituents. So you've got to have the cash flow. If you don't have cash flowing assets, again, you're going to be eating down your principal two ways. One, you'll be taken down by 4% per year, and inflation is going to take it down by another 12, 13, 14, 15% per year. Combined, you're going to run out of money sooner than you thought. In fact, one of our Freedom Founders members recently said that before he joined our group, he said he talked to his financial advisor, and he said, hey, does my wife and I, do we have enough to retire out? And that financial advisor, I think, correctly said, well, Yes, as long as, and here's the catch, as long as we don't have some kind of a market correction, an economic correction in the first few years after your retirement, because that puts a big dent in that principal balance. Well, that's not very much a firm foundation to stand on, is it? So that's why it's up to you to be diligent and prudent about how you look at your financial future. You can't rely on people who, even with their best guesstimate and best history of what they've done, they don't know what the markets look like going forward. They've never been in a place where we had inflation and higher interest rates going up. It's a new cycle, and you've got to be on the forefront. It's what we do in Freedom Founders. It's how we help our people navigate what I've done over the last 42 years. I've done it successfully. I've helped hundreds of other dentists do the same thing to get off of Wall Street and get your money on the Main Street where you actually have more control of it. That's it for me today. Remember, just stay focused on your freedom, and I'll see you next time.